Hey there, everybody. Thomas Wood with Basecamp Trading. It is Monday, November 20th, and we're going to take a look at gold and what happened here. But before I do that, I want to apologize for being out, not having any new video content here the past few days, or most of last week, actually. I've been out sick with the flu, but finally getting feeling better. So getting back in the swing of things, and should be getting more content out here to you guys leading up to Thanksgiving. But talking about gold here, we discussed this in the trading room today, and first thing we actually had talked about with gold this morning was that it was somewhat bullish due to a bull flag on the 240s, and it had triggered that bull flag. Now, the thing about a bull flag, and same thing goes, or the exact opposite goes for a bear flag, is once it has triggered, it should never go back down below the low of the flag. And if it does, it is bearish. It's a bullish pattern that turns bearish, because when the market has an opportunity or has a setup that should cause it to run higher and it fails, then a lot of times you'll see a very quick reaction in the opposite direction, which is what you saw here. So we had a bullish pattern turn bearish, and we ended up coming down and breaking through this double bottom here in a 30-minute time frame. Now, one question I get asked all the time is, Thomas, what's your favorite time frame to trade? Well, for day trading specifically, I really like looking at the 30-minute time frame to determine direction and give me a bias on which way I'm trading, whether or not I'm going long or short. And the reason I do that is because on a 30-minute price chart, we're typically expecting a move to last anywhere from 1 to 3 or 4 price bars. So anywhere from the next 30 minutes to the next 2 hours, we're looking for this setup to play out. So for day trading, that gives us a very good opportunity to jump in and out fairly quickly, within a couple of hours typically, and have very nice returns. Well, in this case, the setup that we had is we had the failed bullish breakout and the failed bull flag on the 240s. And we came down and broke through the double bottom for the support break, and that's your first short entry. Now, a lot of times traders miss that initial entry. So the second thing we look for after the breakout, if you didn't get in on the support break, you look for the first bear flag. And that occurred right here. This was the first bear flag after the support break, and that would have gotten you short about 1284 to catch the remaining 8 or 9 points to the downside here that we had. But with a bear flag, this is exactly how it should play out, because when a bear flag or a bull flag triggers, it should accelerate away from it. Okay, and right here is where it set up and triggered, and we accelerated away, just like we did on Friday. We had a bull flag that triggered and accelerated higher. So exact opposite thing, and that's why I'm talking about quick profits, because with a flag, it should again move very quickly within a bar or two, and you're talking about, in this case, within 30 minutes you're up $600 per contract on the move. So not bad at all. Keep an eye out for this type of setup though. If you don't understand what a bull or bear flag is, there is a link in the description here for that video. I have a whole video talking about what bull and bear flags are, so you can go there and learn a little bit more about what that setup is and how to use it. But that's all I have for you for today. I will see you in the trading room bright and early tomorrow morning. And until next time, don't forget to like and subscribe, and happy trading.